Have we all been misinformed about issues with supply chains and its relationship with inflation? That's what Bridgewater, the investment management company founded by Ray Dalio, has claimed in an incredibly interesting but also quite concerning paper that they wrote at the end of October and mailed out to the public just yesterday. So they say, even as supply disruptions and higher inflation persist, markets are discounting that they will soon subside, leaving inflation at central bank targets and allowing for very easy monetary policy for a very long time. We disagree. Now, it's worth your time reading. It's about 2,000 words long. You can find it on their website, but I'll also summarize the main points for you now in this video. So there are a number of sections to it. They start off with the broad overview section, then they move on to look specifically at the level of goods production, the lack of raw materials, shortage of energy, insufficient productive capacity, lack of inventory or shipping capacity, housing inventory shortages, and labour market issues. So everything I'm going to talk about in this video is from their views, it's their opinion, their analysis, not mine. But I would love to hear your comments as well down in the comment section. Let me know what you think about all of this. Do you agree? Do you disagree? What points do you find interesting? Are you concerned? Also, I'd really appreciate it if you did hit the like button to support this channel. So let's get on with it. Now, Bridgewater say that the news at the moment is focusing on the micro elements of the supply shock. So things like the LA ports issue, shortage of coal in China, lack of truckers in the UK, natural gas in Europe, that whole issue. But the media are ignoring the macro cause that currently has no solution and is likely to continue for the long term. So it's something that will persist. So they say, rather than this being a pandemic-related supply issue, like it's being reported as, it's actually a demand shock that's being driven by what they refer to as MP3, Monetary Policy 3. This is something they've been talking about all year, so you may have come across it before in articles from Ray Dalio and so on. And it's basically all about how monetary policy has evolved. So in the past, we had MP1, which was cutting interest rates. Then we had quantitative easing, which was MP2, like after the financial crisis. And now we have MP3, which is fiscal and monetary policy coordination that we haven't seen during our lifetimes, but has existed in previous forms from a long time ago in other parts of the world. That's what Ray Dalio says, at least. Now, the issue with MP3 is that it's inherently inflationary in a way that previous MPs weren't. So, for example, MP2 after the financial crisis was quantitative easing that wasn't really paired with fiscal stimulus, and it was offsetting credit contraction, so it wasn't inflationary. Whereas MP3 has more than made up for the lost incomes that were experienced by households and so on due to the pandemic, without also making up for lost supply. So this means it's generated demand, but not helped to generate supply. Now, in the financial news, we hear about supply shortages, and this makes us think that supply hasn't got back to normal yet, like we're experiencing a supply shock, like what happened in the 1970s. But that isn't actually true. You see, supply of everything is at all-time highs. So what does this mean for inflation? Well, some inflation factors have been and will be transitory, just like policymakers have been saying, but inflation as a whole is unlikely to be. It's more likely to be persistent. Demand has been heavily for goods rather than services during COVID, but as we recover more and more, demand will shift from goods back to services, and it will still stay very high. So it's the composition of demand that's changing. And actually, Bridgewater see that there could be more spending coming later as MP3 has improved balance sheets and low yields are encouraging more borrowing and spending. However, goods production is already well above the pre-COVID trend. Supply has recovered really quickly, but demand has just exploded, which has created an imbalance unlike anything we've seen since the 1970s. So as demand shifts from goods to services, goods demand will decline, but there are already shortages in services, and this is likely to get much worse. As services demand continues to get back to normal, so it normalizes, it will put even more pressure on the labour market. Even just returning to pre-COVID levels of service demand will push unemployment to historical lows, and this will lead to wages increasing. And household balance sheets are better than they were pre-pandemic. MP3 has led to a huge amount of wealth creation from the rising asset prices, as we've seen in many markets, and it's also lowered debt servicing costs, which means that people have more income. This, combined with people's boosted incomes as economies have reopened, is leading to more money that is available to spend and therefore more demand. But the problem is, there aren't enough raw materials, energy, productive capacity, inventories, housing, or workers. And when you solve a shortage in one area, it just makes the problem worse in another. So let's go through each of those categories that Bridgewater covered in their article. As we've seen a lot this year, there aren't enough raw materials to satisfy the demand at the moment. It's clear from looking at individual markets that the issue is with demand and not with supply. However, there's been a real lack of capex spending over the past decade, so it's difficult to bring more supply online, and some commodities can take up to 10 years to bring new capacity online. So there's no real quick solution to this. So it's not an issue with supply, it's the demand is too high right now. And with economic activity now having to hit higher levels to satisfy demand, there isn't enough energy to power it all. Some constraints are individual ones, like Russia restricting natural gas to Europe, and those are the ones that the media report on mainly, but prices are clearly rising due to a surge in demand rather than a drop in supply. We see this with China, for example, with their issue with coal. And China's actually producing at a rate that's 20% higher compared to the start of 2020. But exports from China are actually 40% higher than then. So there isn't even enough productive capacity to make up for what's needed. Global production has risen above trend, but despite all this surge in supply, it still can't keep up with demand. So to deal with supply chain issues, capex intentions are at highs. However, these are long-term solutions, and in fact, capex is only going to lead to more demand in the short term. That's only going to make things even worse. And not only is there not enough production, there also isn't enough inventory or shipping capacity. For decades, firms have been moving to holding low levels of inventory so that they can improve their margins, as they expected that they can get supplies quickly when they needed them, this just-in-time manufacturing. However, inventories have now collapsed to historically unseen levels, and the percentages of firms with inventory too low are massively higher than anything since 1975. And to make matters worse, the cost of shipping now makes it even more difficult for firms to get supplies delivered when they do need them. And then we come on to labour. There hasn't been a labour market this tight in our lifetimes. Half of all firms are unable to fill their positions, which is higher than any other time since 1975. There are more job openings than there are people that are unemployed. The rate of quits is the highest in history, and a large percentage of people who left the workforce during COVID just aren't coming back. So this has led to wages rising at the fastest rate since the 1980s. Now, Bridgewater also believe that wage rises are the beginning of the next major wave of inflationary pressures. As consumer spending returns to pre-pandemic patterns, it will increase the need for labour. This will lead to wage rises and expectations for higher inflation, which will also need to be included in wages, which means inflation will become self-reinforcing as there would be this wage price spiral, so it would only get worse. And then finally, onto housing. They believe that there's pricing pressure in housing that isn't being reflected properly in inflation stats at the moment, since it lags in the CPI numbers. So ultra-low real rates and improving wages are leading to a housing boom. This has led to US inventories hitting levels lower than anything seen in history. This lack of supply is causing house prices to soar, as well as rent prices. And this isn't just in the US either, but it's actually being seen globally as well. So once this is reported in CPI numbers, they're likely to cause another rise in future. So to wrap things up, Bridgewater say, with demand outstripping supply everywhere you look, policymakers are unlikely to be able to fix shortages across the board. They can open ports for longer, as in the US, or ease environmental regulations, as in China, but in order for supply and demand to clear at levels that don't lead to sustained price increases, there would need to be a massive investment in productivity for supply to catch up. The gap between demand and supply is now large enough that high inflation is likely to be reasonably sustained, particularly because extremely easy policy is encouraging further demand rather than constricting it. So overall, I think you'll agree that that's a pretty worrying report that they've put out there. But what do you think? Are they right about this? Is it something you're concerned about? It's definitely a different view to what we've been seeing from policymakers and the media. And if Bridgewater are right, not only should major central banks be thinking about raising rates like we've been hearing discussions about, but they probably should have already done it. So let me know what you think in the comment section down below. Please do hit the like button if you found this one interesting or informative. I really do appreciate you supporting the channel, and I'll see you in the next one. Thanks for watching.